The market is bleeding red right now as we speak. I just walked off the floor, and I can tell you the energy out there is fear, pure, unfiltered fear. Powell opened his mouth, and within hours, we saw billions of dollars evaporate from the market. Retail investors are sitting at home watching their 401k shrink, watching their savings get cut in half, and they have no idea what just hit them. They're asking themselves, did I do something wrong? Should I have sold yesterday? Should I sell right now? And let me be brutally honest with you. Most of the so-called experts on television right now don't know what they're talking about either. They're guessing. They're reacting. They're playing Monday morning quarterback with your money. But here's what they're missing, and here's what you're about to understand in the next few minutes that separates the wealthy from the wiped out. This crash was not an accident. This was not the market simply having a bad day. This was a calculated move. This was Powell finally doing what he said he would do, and most investors didn't take him seriously until this very moment. Right now, we're watching a transfer of wealth happen in real time. The question is not whether the market is crashing. The question is whether you are going to be on the side that loses everything or the side that understands the game well enough to survive and eventually thrive. And eventually thrive, this is the moment where portfolios are either destroyed or fortified. This is the moment where panic sellers hand their hard-earned money to patient buyers who understand what's actually happening beneath the surface. And I'm going to break this down for you in a way that no mainstream financial news channel will, because they need you scared, they need you glued to your screen watching ads. I need you educated. I need you thinking clearly. I need you acting like a CEO of your own financial life rather than a passenger on a crashing plane. So before we go any deeper into exactly what Powell just did and why it's going to trigger a chain reaction that most investors won't see coming until it's too late, I need you to do something for me. I need you to look down at your screen right now and find that subscribe button. If you're watching on YouTube, click it. If you're listening on a podcast platform, follow the show. And here's why this matters. Back in 2016, when Brexit hit and the markets plunged overnight in a way that nobody predicted, I walked into our trading floor in London. Young traders were panicking. They were selling positions they'd held for years because they couldn't handle the uncertainty. I pulled them aside and I told them something I need you to hear right now. I said, this is where we earn our bonuses. This is where decades of experience pay off. The people selling right now are selling to us. And in 2 years, they're going to wonder why they're still renting while we're buying second homes. That clarity didn't come from luck. It came from understanding the system. It came from having a framework that works whether the market is up or down. By subscribing to Dinology, you are building that framework for yourself. Your future self, 5 years from now, 10 years from now, will look back at this moment and thank you for having the discipline to learn rather than panic. So do it right now. Click subscribe, turn on notifications, because what we're about to discuss regarding Powell's move and the cascade of consequences that follow is going to separate the investors from the gamblers. Now let's talk about what actually happened here, because context matters more than price. Powell stood at that podium and he delivered a message that the market did not want to hear. He signaled that rates are staying higher for longer. He signaled that inflation is not defeated despite what the optimistic headlines suggested, and the market reacted the way markets always react when they realize Santa isn't coming. They sold first and asked questions later. But here's what you need to understand that the average retail investor completely misses. Powell isn't trying to crash the market. Powell is trying to save the economy, and sometimes saving the economy requires breaking the market temporarily. As a CEO of JP Morgan Chase, I sit in rooms that most people never see. I talk to Treasury officials. I talk to regulators. I talk to CEOs running companies that employ hundreds of thousands of people. And I can tell you with absolute certainty that the data we're seeing right now is confusing, even for those of us who have done this for 40 years. Inflation is sticky in a way we haven't seen since the 1970s. The consumer, despite what you hear about strong spending, is starting to show real signs of strain. Credit card debt is mounting, savings are depleting, and when Powell looks at this data, he has two choices. He can declare victory and lower rates, which would cause inflation to surge back immediately and destroy the middle class through higher prices on everything from groceries to gas, or he can keep pressure on the economy, which means keeping pressure on the stock market until inflation is truly dead. He chose the second option, and frankly, it's the responsible choice, even though it hurts right now. But here's where the psychology gets dangerous. When markets drop this fast, the human brain doesn't process it as opportunity. It processes it as threat. Your amygdala, that primitive part of your brain that kept your ancestors from getting eaten by lions, lights up and screams at you to run. Sell now, cut losses, get to safety, and that instinct, which served who? Humanity well for 100,000 years on the savannah is absolutely disastrous in financial markets. I see this every single day. I see intelligent, educated people make terrible decisions simply because they cannot sit still during volatility. They feel like they have to do something, so they do the wrong thing. They sell at the bottom, they buy the top. They trade their long-term wealth for short-term comfort. And right now, as we speak, that exact psychological drama is playing out in millions of households across this country. The question is whether you're going to recognize that voice in your head for what it is, a primitive survival mechanism that doesn't understand modern finance, or whether you're going to let it drive you off a cliff. When I was young, just starting out at American Express and later at Citigroup, I made this exact mistake. I saw a position I believed in start to drop, and instead of asking whether my original thesis was still valid, I panicked. I sold, I locked in the loss, and then I watched that same position recover and go on to double over the next 18 months. That lesson cost me money, but more importantly, it taught me something invaluable about myself and about markets. The pain of watching a loss is temporary, but the pain of missing a recovery because you sold in fear lasts much longer. Now here's the piece that most financial commentators won't tell you because they don't understand it themselves. Powell's move today wasn't just about interest rates. It was about sending a signal to every institutional investor, every pension fund, every sovereign wealth fund, and every retail trader that the party's over and the cleanup has begun. For the last 15 years, we've lived in an era of easy money, zero interest rates, quantitative easing. Money literally printed and handed out. That environment created behaviors that work beautifully. As long as the music played, it rewarded leverage, it rewarded speculation, it rewarded buying anything with a narrative regardless of valuation. But that era is dead, and Powell just officiated the funeral. What comes next is a regime shift, and regime shifts are always violent. They're always uncomfortable. They always punish the people who are slowest to adapt. And if you're sitting there right now watching your portfolio drop and feeling that pit in your stomach, you need to ask yourself a brutally honest question. Are you invested in companies with real earnings, real cash flow, real competitive advantages that will exist in 5 years, regardless of the economic environment? Or are you invested in stories that only worked when money was free and speculation was rampant? Because that distinction is going to determine whether this moment is a buying opportunity or a permanent loss of capital. And I'm not telling you this to scare you. I'm telling you this because as someone who has managed through the 1987 crash, the dot-com bubble, the 2008 financial crisis, and the COVID crash, I've seen this movie before. I know how it ends for people who panic, and I know how it ends for people who keep their heads. The people who panic end up broke, bitter, and convinced the market is rigged against them. The people who keep their heads end up wealthy, retired comfortably, and able to help their kids and grandkids build lives. Which group do you want to be in? Because the choice you make in the next 72 hours, while this volatility is at its peak, matters more than almost any other financial decision you'll make this year. But here's a cliffhanger that should keep you watching, because this is where it gets really interesting. What I just described, the regime shift, the end of easy money, the need for fundamental analysis, that's the mainstream explanant. ION, that's what you'll hear on CNBC and Bloomberg. But there's a deeper layer here that nobody's talking about, and it involves the commercial real estate market, regional banks, and a ticking time bomb that Powell just primed with today's announcement. If you don't understand how these pieces connect, you're going to walk into the next phase of this market completely blind. You're going to think you're buying the dip when you're actually catching a falling knife. So here's what I want you to do right now. Take a deep breath. Step away from your brokerage account for the next 10 minutes. Don't sell anything. Don't buy anything. Just breathe and prepare your mind for what comes next, because in just a moment, I'm going to show you the hidden connection between Powell's words today and the crisis that's quietly building in an area of the economy that most retail investors never even think about. That connection is going to determine whether this correction turns into something much more serious, and understanding it might be the difference between protecting your capital and watching it disappear. Stay with me. Let me take you inside that hidden connection right now, because this is where the average investor gets completely blindsided. You see, when Powell signaled that rates are staying higher for longer, he didn't just affect the stock market. He sent a shockwave through the entire financial system. And the place where that shockwave is going to land hardest is commercial real estate. Now, I know what you're thinking. You're thinking, Jamie, I don't own commercial real estate. I own tech stocks and crypto and maybe some ETFs. Why should I care about office buildings? And that is exactly the mistake that's going to cost people everything in the coming months. As the CEO of JP Morgan Chase, I have to look at the economy as a system. I have to understand how fear, not parts connect, how stress in one area bleeds into another. And right now, the commercial real estate market is under a level of stress we haven't seen since 2008. Think about what's happening. Office buildings in major cities are sitting half empty because work from home changed everything. Companies are downsizing their footprints, leases are expiring and not being renewed. And at the same time, interest rates are high, which means refinancing those buildings is becoming impossible for many owners. They borrowed at 3%, and now they're looking at refinancing at 7% with lower occupancy. The math doesn't work. It simply doesn't. And when the math doesn't work, defaults start to happen. Now, here's where it connects to you. Most of these commercial real estate loans aren't held by giant banks like JP Morgan. We have the balance sheet and the diversification to absorb losses. The problem is regional banks. The lenders that your local businesses rely on, they hold a massive percentage of commercial real estate debt, and unlike the big banks, they don't have hundreds of billions in trading revenue or investment banking fees to fall back on. Their entire business model is taking deposits and making loans, and if those loans start going bad, they face a solvency crisis. They have to tighten lending standards. They have to call in loans. They have to stop lending to new businesses. And this is where it hits your portfolio, because when regional banks stop lending, small businesses can't grow, small businesses can't hire, small businesses can't invest in new equipment or technology, and small businesses employ about half of all American workers. So now you have a domino effect that starts with empty office buildings and ends with layoffs, reduced consumer spending, and lower corporate earnings across every sector. That technology stock. Customers or small businesses who might be struggling, that consumer discretionary stock, its customers or workers who might be getting laid off or having their hours cut. This is how a crisis in a sector you don't even think about becomes a crisis in your portfolio. And most investors won't see it coming until the earnings reports start coming in 6 months from now, and suddenly the narrative changes from the economy is resilient to we're in a recession.
I need you to understand something about how I think as a CEO.
Because it applies directly to how you should be thinking about your money right now. When we stress test JP Morgan, we don't just look at what happens if stocks go down. We look at interconnected scenarios. We ask what happens if unemployment rises at the same time that real estate falls, at the same time that corporate defaults spike. We model the impossible because the impossible happens more often than people think. And right now, I'm looking at the regional banking sector, and I'm seeing stress that most investors are completely ignoring. The reason they're ignoring it is psychological. We just went through a regional banking crisis last year with Silicon Valley Bank and Signature and First Republic, and those banks failed, and the government stepped in, and everything seemed fine. So the brain says, we already had that crisis, we're done. Check that box. But markets don't work that way. Stress builds, pauses, and builds again. The underlying problem with commercial real estate didn't get solved last year, it got worse. And now with Powell confirming that rates aren't coming down anytime soon, that stress just got ratcheted up another level. I was in the room in 2000 and 2008. I saw how it started with subprime mortgages, which seemed like a small corner of the market that wouldn't affect anyone who had good credit. And then I watched it SPID, red to everything. I watched banks fail. I watched the government step in. I watched the market drop 50% from its peak. And the people who got hurt weren't the speculators who deserved to lose money. It was regular people with 401 cash and pension funds who didn't even know what a subprime mortgage was. They just trusted that the system would protect them, and the system couldn't because the stress was too interconnected. I'm not saying we're heading for 2008 again. The banking system today is better capitalized. Regulation is stronger. But I am saying that when you ignore the connections between seemingly unrelated parts of the economy, you expose yourself to risks you don't even know exist. So what do you do about this? What does a smart investor do when they see a domino effect starting to line up? The first thing I would do if I were sitting in your chair right now is look at my exposure to regional banks. Not just owning the stocks themselves, but owning funds that have significant regional bank holdings. I would look at commercial real estate REITs and ask whether the dividend is worth the risk of principal loss. I would look at any company that relies heavily on small business customers and ask how they'll perform if credit tightens further. This isn't about panic selling. This is about awareness. This is about looking at your portfolio through the lens of an operator rather than an investor. When I look at a potential acquisition for JP Morgan, I don't just look at the income statement. I look at the balance sheet. I look at the counterparty risks. I look at what happens to them if the economy turns down 20%. You need to do the same thing with your investments. You need to ask, not just is this a good company, but how does this company hold up if regional banks stop lending and small businesses start failing? Because that scenario is becoming more likely by the day, and the market hasn't priced it in yet. The market is still focused on inflation data and jobs reports and Fed speeches. It hasn't connected the dots to commercial real estate and regional banks. That means when the connection becomes obvious, there will be another leg down, another wave of selling, another opportunity for panic to spread. And you need to be positioned for that, not caught off guard by it. This brings me to the psychological challenge that's going to define the next 6 months for every investor watching this video. The human mind craves certainty. It wants to know that if you just hold on, everything will be okay. It wants to believe that the Fed will eventually ride to the rescue and cut rates and save the market. And that desire for certainty is going to be exploited by every financial media outlet, every social media influencer, every newsletter promising that the bottom is in and it's time to buy. But the reality is that we don't know when the bottom is in. We don't know how bad the commercial real estate stress will get. We don't know which regional banks have hidden problems that haven't surfaced yet. And admitting that you don't know is actually a strength, not a weakness. When I took over as CEO of JP Morgan in 2005, I didn't pretend to have all the answers. I built a team of people who were smarter than me in their specific areas, and I empowered them to tell me the truth, even when the truth was scary. You need to do the same thing with your portfolio. You need to create space for the possibility that things get worse before they get better. You need to ask yourself the hard question. If the market drops another 20% from here, will I be able to sleep at night? Will I be able to hold my positions? Will I be forced to sell because I need the money or because I can't handle the pain? Because if the answer to any of those questions is no, then your risk is too high right now. You need to reduce it. You need to sell enough to get to a sleep well point, even if it means missing out on some upside if the market rallies. The greatest investors I've known in my 40 years in this business aren't the ones who made the most money in the good times. They're the ones who survived the bad times with enough capital to take advantage of the opportunities that crashes create. They're the ones who understood that preserving capital is not the opposite of making money. It's the prerequisite for making money over the long term. When I was a young man starting out, I made a mistake that I still think about today. I thought I was smarter than the market. I saw a dip, and I was so confident it would bounce back that I leveraged up. I borrowed money to buy more. I was certain, absolutely certain. And then the news got worse and worse, and I watched my positions drop below my margin requirements. I got the call, the margin call that every trader dreads. I had to sell at the worst possible time at the lowest prices because I had borrowed and the bank wanted its money back. I felt shame. I felt like I had failed. I felt like everyone was watching me lose money I didn't have to lose. That feeling, that shame, almost made me leave the business. But I stayed, and I learned the most important lesson in my career. Leverage turns temporary losses into permanent ones. Borrowing turns volatility into disaster. And confidence, no matter how justified, is not a substitute for liquidity. I tell you this story not to impress you with how far I've come, but to show you that even someone who runs the largest bank in America has made the mistakes you're making or considering making. The difference is that I made them when the stakes were lower, when I had time to recover, when the lessons cost me money but not my future. You have that same opportunity right now. You can learn from this moment without being destroyed by it. You can adjust your risk, reduce your leverage, increase your cash, and live to fight another day. Or you can double down, convinced that you know better, and risk getting that margin call that ends your investing career before it really begins. But here's the cliffhanger that should keep you watching, because this is where the opportunity hides within the crisis. Everything I've described so far sounds scary. Commercial, real estate, regional banks, domino effects, margin calls, and it should be scary because dismissing risk is how people get hurt. But within every crisis, within every panic, within every moment when the crowd is selling without thinking, there are opportunities that only exist because of the fear. There are assets that get sold for no reason other than that someone else is selling. There are businesses with strong balance sheets and growing earnings, that trade at prices that make no sense except that the market is irrational. And if you have cash, if you have patience, if you have the ability to think clearly while everyone else is losing their minds, you can position yourself for the kind of returns that change your financial life forever. The question is whether you have the discipline to wait for those opportunities, the courage to act when they appear, and the wisdom to know the difference between a value and a value trap. In just a moment, I'm going to show you exactly how I think about finding those opportunities, how I separate the companies that are truly cheap from the companies that are cheap for a reason, and how you can apply the same framework whether you're managing $1 billion or $1,000. Because the size of your account doesn't determine your success. Your mindset determines your success. So your framework determines your success. Your ability to resist the emotional contagion of the crowd determines your success. Stay with me. Now we arrive at the moment where most people check out emotionally, and that's exactly why this is the most important part of our conversation. When the news is scary, when the market is dropping, when every headline screams crisis, the natural human response is to look away, to distract yourself, to tell yourself you'll figure it out later. But later is when the opportunities are gone. Later is when the smart money has already moved. Later is when you're left wondering why everyone else seems to recover faster than you do. So I need you to stay with me right now, because we're going to turn this moment of fear into a framework for action. We're going to take everything we've discussed about Powell, about commercial real estate, about regional banks, about psychological traps, and we're going to translate it into a practical approach that you can use starting today, regardless of whether you have $10,000 or $10 million invested. The first thing I want you to understand about finding opportunity in chaos is that price and value are not the same thing. This is the single most important concept in all of investing, and it's the one most easily forgotten when markets are falling. Price is what you pay, value is what you get. And right now, prices are falling across the board, but value is not falling equally. Some companies are getting cheaper because their business is genuinely deteriorating, their customers are disappearing, their debt is becoming unmanageable, their competitive advantage is eroding. Those companies are value traps, and buying them just because they're down 50% is a fast way to lose the other 50%. But other companies are getting cheaper simply because the market is selling. Everything the institutional investors who need to raise cash for redemptions don't ask whether a company is good or bad. They sell whatever they can sell quickly. The hedge funds facing margin calls don't do fundamental analysis in the moment. They sell their most liquid positions regardless of quality. The retail investors panicking at home don't distinguish between a company with a strong balance sheet and a company on the verge of bankruptcy. They just see red and hit sell. This creates a situation where high-quality companies trade at prices that make no sense, except for the fact that someone else is selling. And those are the opportunities that build wealth. As a CEO of JP Morgan Chase, I see this dynamic play out in real time. I see companies come to us for financing that have rock-solid businesses but temporarily depressed stock prices because of market conditions. I see private equity firms raising capital specifically to buy public companies that have been unfairly punished. I see the wealthy getting wealthier not because they're smarter than everyone else, but because they have the liquidity to act when others are forced to sell. And I want you to understand that you don't need to be a billionaire to participate in this dynamic. You just need to have cash available when everyone else is panicking. You just need to have the emotional discipline to buy when buying feels scary. You just need to have a framework for distinguishing between a company that's temporary cheap and a company that's permanently impaired. So let me give you that framework right now. The same framework I use when evaluating potential acquisitions for JP Morgan, and the same framework I use when managing my personal portfolio. The first thing I look at is the balance sheet. I want to know how much debt a company has, when that debt comes due, and what interest rates they're paying. In a high-rate environment, debt is a killer. Companies that need to refinance in the next year or two are facing much higher interest costs, which will crush their earnings and potentially force them to raise capital at depressed prices. Companies with little or no debt, or with debt locked in at low rates for many years, have a massive advantage. They can survive a downturn. They can invest while competitors are struggling. They can even acquire weaker competitors at bargain prices. When I look at the balance sheet, I'm looking for survival. I'm asking whether this company can make it through 2 years of recession without needing to raise money. If the answer is yes, then I can start thinking about value. The second thing I look at is the business model. I want to understand how this company makes money and whether that revenue is likely to continue regardless of economic conditions. Companies that sell necessities, things people need, regardless of whether the economy is good or bad, have a natural advantage. Healthcare, utilities, consumer staples, certain types of business services. Companies that sell luxuries or discretionary items face much more uncertainty. When people lose their jobs or worry about losing their jobs, they stop buying the new car, the new phone, the vacation home. They don't stop buying medication, electricity, or food. This doesn't mean you should only invest in boring defensive companies. It means you need to price in the cyclical risk. You need to demand a higher margin of safety when you invest in companies that will suffer in a downturn. You need to ask yourself whether the potential upside justifies the very real possibility of earnings declining for a year or two. The third thing I look at is management. This is the hardest thing to evaluate from the outside, but it's also the most important. I've seen great businesses destroyed by bad management, and I've seen mediocre businesses transformed by great management. When I evaluate management, I look for three things: candor, capital allocation, and long-term thinking. Candor means they tell you the truth even when the truth is ugly. They don't hide problems. They don't spin bad news. They lay out the challenges and explain how they're addressing them and explain how they're addressing them. Capital allocation means they're disciplined about how they use shareholder money. They don't make expensive acquisitions just to get bigger. They don't buy back stock at inflated prices. They return capital to shareholders when they have excess cash and invest in the business when the return justify it. Long-term thinking means they're building for decades, not quarters. They're investing in research, in talent, in infrastructure, even when it hurts short-term earnings. When I find a company with a strong balance sheet, a resilient business model, and management that demonstrates these qualities, I don't care much about what the stock price does in the next 3 months. I care about where that company will be in 3 years, in 5 years, in 10 years. Now let me apply this framework to the current moment and tell you what I would be looking at if I were sitting in your chair. I would be looking at technology companies that have massive cash piles, minimal debt, and products that businesses and consumers can't live without. The sell-off in tech has been brutal, but many of the largest technology companies have balance sheets that would make a bank jealous. They have hundreds of billions in cash. They generate massive free cash flow every quarter. They have pricing power and competitive moats that have been built over decades. And the market sells these companies because rates are high. It creates an opportunity for patient investors who understand that interest rates will eventually come down and these companies will still dominate their industries. I would be looking at healthcare companies that benefit from demographic trends that aren't going away. The population is aging. People need more healthcare as they age. That's not a cyclical trend. That's a structural reality, and many healthcare companies have been sold off along with everything else, creating valuations that don't reflect the underlying demand for their products and services. I would be looking at energy companies that have transformed their businesses over the last decade. They're no longer the speculative plays they used to be. They've paid down debt. They've become disciplined about capital spending. They're returning cash to shareholders through dividends and buybacks. And the world still needs energy, regardless of whether we're in a recession or not. But here's what I would not be doing. I would not be trying to catch the exact bottom. I've never met anyone who can consistently time the market, and I've met some of the best investors in the world. The people who try to buy at the absolute low and sell at the absolute high end up missing a move entirely because they're waiting for confirmation that never comes. Instead, I would be dollar cost averaging. I would be buying a little bit every week or every month, knowing that some of those purchases will happen at higher prices and some at lower prices, but that over time, I'll build a position at a reasonable average cost. This approach takes the emotion out of it. It prevents you from kicking yourself for buying too early. It prevents you from waiting forever and missing the recovery entirely. I would also be increasing my cash position if I didn't already have liquor. This might sound counterintuitive when I'm talking about buying opportunities, but cash is option value. Cash gives you the ability to act when opportunities appear. If you're fully invested right now and the market drops another 20%, you'll be forced to watch the opportunity pass you by because you won't have anything to buy with. By holding some cash, by being patient, by waiting for the moments when fear is highest and prices are lowest, you position yourself to take advantage of the irrationality of others. I need to be honest with you about something that most financial personalities won't say because it doesn't fit their narrative. The recovery from this moment might not look like the recoveries you're used to. We've become conditioned to V-shaped recoveries, to markets that bounce back within months, to the Fed riding to the rescue with rate cuts and stimulus. That might not happen this time. This correction could be prolonged. It could be painful. It could test your patience in ways you haven't been tested before. And if you're investing money that you need in the next year or two, if you're investing money that you can't afford to lose, if you're investing money that keeps you up at night, you need to reconsider whether you should be in the market at all. The stock market is for money that you can leave alone for years, for decades. It's for money that can withstand the inevitable downturns and wait for the eventual recoveries. If you need that money for a house down payment next year, or for tuition next semester, or for any short-term need, it doesn't belong in stocks no matter how attractive the valuations look. When I think about the investors I admire most, the ones who built real wealth over decades, they share a common characteristic: patience. Not intelligence, though many of them are smart. Not access to information, though you're well informed. Patience, the ability to buy and hold, the ability to ignore the noise, the ability to let compound interest work its magic over decades rather than days. Warren Buffett made most of his money after he turned 65. Think about that. The greatest investor of all time did most of his wealth creation late in life because he understood that investing is about timing the market, not timing the market. He understood that trying to get rich quickly is the surest path to getting poor quickly. He understood that the tortoise really does beat the hare in the world of investing. I want you to think about your own financial journey in that context. Where do you want to be in 10 years? In 20 years? In 30 years, when you're retired and looking back on your career, do you want to remember a time when you panicked and sold at the bottom, locking in losses and missing the recovery? Or do you want to remember a time when you stayed calm, stuck to your plan, and watched your patience pay off as the market eventually recognized the value you saw when everyone else was fearful? The choice you make today in this moment of uncertainty will echo through your financial life for decades. It will determine not just how much money you have, but how you feel about yourself as an investor. It will determine whether you approach the next market downturn with confidence or with fear. I started this conversation by telling you that Powell crashed the market and that investors didn't see it coming, and that's true. Most people are caught off guard. Most people are reacting emotionally. Most people are making decisions based on fear rather than framework. But you're not most people anymore. You've taken the time to understand what's really happening beneath the surface. You've looked at the connections between commercial real estate and regional banks and your Overwatch Capita round portfolio. You've considered the psychological traps that lead investors astray. You've developed a framework for evaluating companies based on balance sheets, business models, and management quality. You've thought about your own time horizon and your own tolerance for risk. You're not just reacting to the news anymore. You're thinking like an owner. You're thinking like a CEO of your own financial life. And that's really what Dimon is all about. It's not about getting rich quick. It's not about timing the market perfectly. It's not about following tips or tricks or hot stock picks. It's about developing the mindset, the framework, the discipline that allows you to navigate any market environment with confidence. It's about understanding that the stock market is not a casino. It's a mechanism for owning pieces of productive businesses that generate value over time. It's about recognizing that volatility is not risk if you have the right time horizon and the right temperament. Volatility is opportunity. Volatility is a mechanism by which wealth is transferred from the impatient to the patient, from the emotional to the disciplined, from the crowd to the individual who can think for themselves. So here's what I want you to do right now. I want you to close your brokerage app. I want you to stop watching the ticker. I want you to take a piece of paper and write down your investment plan. Write down why you own what you own. Write down what have to change for you to sell. Write down how much cash you want to hold. Write down how much you're going to invest each month, regardless of what the market does. Put that piece of paper somewhere you can see it. And then when the market drops another 5% and your phone starts buzzing with news alerts and your friends are panicking and every instinct tells you to sell, look at that piece of paper. Remind yourself while you're doing this. Remind yourself that you have a plan. Remind yourself that the crowd is usually wrong at the extremes. Remind yourself that this moment, this scary, uncertain, painful moment, is exactly when fortunes are made by those who keep their heads while others lose theirs. This is Jamie Dimon reminding you that the market will always test you. It'll always find your weakest point and push on it until you break or until you learn. The question is whether you'll let this moment break you or whether you'll let it teach you. The choice, as always, is yours. Stay disciplined, stay informed, and I'll see you in the next video.